life insurance. For most of us, that phrase probably brings to mind a pretty standard idea, a policy that pays out when we're gone. Simple, right? But what if I told you there's a whole other world of insurance out there? We're talking about complex financial strategies, super specialized policies for unique situations, and yeah, even some practices that are completely forbidden. Today, we're going to pull back the curtain on all of it. So, if you've been thinking that life insurance is a straightforward, one-size-fits-all kind of deal, well, you're in for a bit of a surprise. We're about to dive into this fascinating landscape of policies, everything from ones designed for very specific life events to others that act as some pretty sophisticated financial tools. And we're even going to venture into the shadows a bit to look at a type of insurance so controversial it's actually been outlawed. Okay, first up, let's look at policies that take that traditional insurance model and just give it a little twist. You can think of these as the niche players in the game, designed for very specific circumstances and needs. So, first on our list is accidental death and dismemberment, or AD&D. And the key word here, the most important word, is accidental. This is not a policy that's going to pay out if you die from an illness or old age. Nope. It's specifically designed for the unexpected, the sudden, the tragic accidents of life. So what exactly does it cover? Well, we're talking about truly life-altering events. Accidental death is the big one, of course, but it also covers catastrophic injuries like losing a limb or your sight or being paralyzed. It's really meant to be an extra layer of protection for when the absolute unthinkable happens. Now, what if you're looking for a different kind of convenience? What if you want life insurance, but you could do without the needles and the whole doctor's visit thing? Well, that's the big appeal of non-medical life insurance. Just like the name says, you can get coverage without having to go through a medical exam. But, and you knew there was a but coming, there's always a trade-off. You might get to skip the exam, but the insurance company still has to figure out how risky you are. So without a detailed medical picture, they basically have to average out the risk across everyone. And what does that mean for you? Well, it usually means higher premiums. You're essentially paying for the convenience of skipping that doctor's appointment. Okay, now here's a policy that breaks one of the fundamental rules of traditional cash value life insurance. See, in a standard policy, when the insured person passes away, the beneficiary gets the death benefit, the face amount, but the insurance company keeps the cash value that's built up over the years. This policy, it's totally different. It pays out both. So you're probably wondering, why isn't everyone rushing out to buy this kind of policy? I mean, it sounds great, right? The answer, as you might have guessed, comes down to cost. Because the potential payout is so much larger, the premiums are significantly higher, and that makes it a pretty rare specialty product, mostly for those with really deep pockets. All right, let's level up here. We're moving beyond insurance as just a simple safety net and into the world of insurance as a powerful financial tool. This is where things start to get really interesting. First in this category, we have a financing strategy called minimum deposit insurance. The basic idea here is to use the policy's own cash value to pay its premiums. It's a pretty sophisticated technique, and it's often used by high-income earners who are looking for tax-efficient ways to manage their finances, since the interest on the loan can sometimes be a deductible expense. So how does this actually work in practice? Let's walk through it. Your premium is due, but instead of writing a check from your bank account, you take a loan against the cash value your policy has already built up. You use that loan to pay the premium, and your only real out-of-pocket expense is the interest on that loan. You're basically leveraging the policy to pay for itself. Pretty clever, huh? Next, let's talk about a really key distinction you'll find in the world of life insurance: participating versus non-participating policies. The easiest way to think about a participating policy is to imagine you're part of a co-op. If the insurance company has a really profitable year, they share some of those profits back with you, usually in the form of dividends. A non-participating policy, on the other hand, well, it doesn't offer that feature. What you see is what you get. And now for our final section. We're about to step into the shadows of the insurance world. This is a place where the lines get really blurry between a financial strategy and a dangerous gamble. And what we're about to discuss isn't just controversial, it's straight up illegal. Our source material really puts it bluntly. It says, simply put, these schemes are wagers on human life. That is a chilling statement, and it gets right to the very heart of why these practices are so controversial. This is what's known as stranger-owned life insurance, or STOLI. Now, a fundamental principle of all insurance is something called insurable interest. It basically means you can only take out a policy on someone if their death would cause you some kind of financial hardship. Stoli is a scheme designed to completely blow that principle to pieces. It's where strangers, people with zero connection to the insured person, take out a policy on them, essentially betting on when they will die so they can collect the payout.
A very close cousin of Stoli is investor-owned life insurance, or IOLI. The idea is exactly the same. An outside party funds a policy on someone's life just for profit. The main difference is really about who starts the process. With IOLI, it's the investor who is actively seeking people out to insure, treating human lives almost like stocks in a portfolio.
So let's be perfectly clear about where these arrangements stand legally. There is absolutely no gray area here. Both STOI and IOI transactions are considered fraudulent, period. So just to sum it up, these schemes are illegal in most places because they violate that fundamental rule of insurable interest. Now, it is really important not to confuse this with a legal life settlement. That's where someone who already owns a policy decides to sell it to a third party. The huge difference is that Stoli and IOLI are about creating policies from scratch with the sole intention of profiting from a stranger's death.
So after all that, what's the big takeaway? We've seen that life insurance is so much more than just a simple death benefit, right? It can be a specialized shield against accidents, a really sophisticated tool for managing your wealth, and, in the wrong hands, it can be a vehicle for a pretty grim financial wager. And all of this leaves us with a really critical question. In a world of financial products that just keep getting more and more complex, where exactly do we draw the line between a smart financial tool and a dangerous gamble on human life? It's definitely a question worth thinking about. Thanks for joining me.